Episode 7 of The Wealth Show with Equity Kings. Welcome to The Wealth Show with Equity Kings. My name is Tumisho Ramodisa, and today's episode I want to take a different turn and just talk about quantitative easing and deflation and inflation as the title of this episode suggests. But really, I want to get more technical in this episode because I think the previous episodes I wasn't technical enough. So I just want to get into more technicalities and into the data as the data suggests. So I want to first beg the question to you guys, what is inflation? Because this is something that people don't understand, because inflation is not a rise in consumer prices. I mean, the dictionary right there, it does say that. It says inflation is a rise in the consumer prices over a prolonged period of time, which means that's not transitory. So that is a bad definition of inflation. I'm sorry to say that is a poor definition of inflation. Look at the dictionary of inflation. Look at the 1970s dictionary, Webster Dictionary. I think it's Webster Dictionary. The definition of inflation is an expansion of the money supply, or to inflate a wheel or something like that, because there's two definitions of it. There's the economical definition and there's the practical definition, which has to do with inflating something. So you can't inflate prices. This is something I've talked about many times. I've tweeted about it before. So if you haven't been following me on Twitter, you should do so at NatureBoy. Nature _boy, or you can just type Tumisho Ramodisa and you'll just find me there. Or you can follow us on Equity Kings on Twitter. It's just Equity Kings. So going back to the topic of inflation, inflate, it means to inflate something. You can't inflate prices because prices only go up. I heard this from Peter Schiff because Peter Schiff explains it so beautifully. Prices go up, but they do not inflate. That's something we have to understand. Prices do not inflate. So how can you possibly say inflation is prices going up? That is not true. That is grammatically, that is scientifically incorrect at all. Inflation is an expansion of the money supply, because when you inflate a wheel, you are expanding the wheel becomes bigger. It's not going up, it's becoming bigger, because you don't know the direction. You can't say it's going up. Prices are rising. You can't say the wheel is just going up. So inflation is expanding the money supply in economics. That is what it is. And what we saw in March 2020 is the Fed expanding the money supply, the ECB expanding the money supply with their reckless negative interest rate policies. So Bank of Japan expanding the money supply. By definition, that is inflation. So I don't want to compare the inflations of Japan and the European Central Bank and the Fed. I just want to talk about specifically the Fed, and I'll just go back to South Africa's one. But maybe I won't do that in this podcast episode. But talking about inflating the money supply, the Fed inflated the money supply 25% of inflation. So people like to say that, oh, this is actually gonna increase consumer prices. Maybe and maybe not, because you have to understand, how did the Fed come about creating those new dollars? Because deflationists, I was recently listening to I think it was Stephen van Metre. In America, they say Stephen Van Meter. I don't know why they call it Van Meter, why they call him Van Meter. That's wrong. It's Stephen van Metre in Afrikaans or in Dutch, to say the least. So Stephen van Metre recently said that QE is deflationary, quantitative easing, which is when the Fed creates bank reserves to buy treasuries from the banks, their primary dealers. Because this is how the economy works. The economy works like this. The banks are banking with the Fed, essentially. Because if I have a bank account with, let's say, JP Morgan, for South Africa's example, FNB, if I have an account with this bank, this ABC bank, let me just keep it simple like that. If I have an account with ABC bank, that is a liability. The money that I have in there, my checking account, is a liability of ABC bank, because those are my deposits. It's not his. It can't be his asset. It's his liability, because it's an IOU, which basically says I owe you. So the bank says they owe you this amount, whatever's in your checking account. That's why it's called an IOU. And it's an asset. It's my asset because it's my deposits. So what happens is I can spend those deposits in the real economy. I can do whatever I want with it. So it's a liability of the bank. That's what we have to understand. And The same thing happens when ABC Bank is doing banking with the Fed, because banks have to bank with someone else, because a bank can't bank with another bank. It has to bank with a reserve bank, which is the central bank or the reserve bank, whatever you want to call it. So in this case, JP Morgan or whatever, Wells Fargo, these are primary dealers. What does primary dealers mean? Primary dealers means that this bank is actually banking with the Fed and has accounts with the Fed. So that's what it means. Not all banks are primary dealers, because not all banks have accounts with the Fed. So banks are the only ones that have accounts with the Fed and the government and probably I'm not sure if government agencies do. I remember on the New York Fed's website they showed they were illustrating this chart on how the dollar funding market works and the Federal Reserve's balance sheet. But as far as I'm concerned, I don't think government agencies have accounts with the Fed. But from what I know is the government itself, the National Treasury, and primary dealers have an account with the Fed. So that's something that we have to understand. And now that we understand that, banks have a checking account with the Fed. So ABC Bank has a checking account with the Fed. I want you guys to listen to me very carefully. ABC Bank has a checking account with the Fed. So what happens is that the money that's in his checking account is called a bank reserve, or for people who don't understand financial terms, let's call it a deposit. So it's just the same thing as me banking with some other bank. It's a deposit, or I can call it a bank reserve. So in the financial system, we like using the term bank reserves for banks, and then we like using the term deposits for customers, like individuals like me and you, the average Joe and Jane. But let's just say that is a bank reserve. So that is a liability of the Federal Reserve, and that is an asset of the bank, right? So the Fed has assets on its balance sheet and it has liabilities, so they have to match up. So let's just, for this example, I want to simplify things, and I'm not going to involve the Treasury yet. I will involve the Treasury after I just explain this concept. So these people, I'll just explain why I think these deflationists are saying QE is deflationary, and I'll debunk that myth, or I'll just try and balance with them. So what happens is, the Fed or the banks have two types of bank reserves. So first of all, they have the average bank reserves, which come from the deposits of our deposits. So when we have deposits, banks are required to keep 10% of our deposits in reserves. So they have that part of reserves, and then they have excess reserves. So excess reserves is the money that they get from other places, maybe from investments, from other things. Those are excess reserves, right? So bank reserves, there are two types of bank reserves. There's excess reserves and there's an interest on that, which I'll explain later. So there's excess reserves and there's normal reserves, because in a fractional reserve system, a bank has to keep 10% of the deposit. So if I have a bank account with ABC Bank and I deposit 1,000 units, let me say 1,000 currency units, so I can cater for every single country, everyone from different countries who's listening to this. So I have 1,000 units in my bank account, right? And then what happens is, because I deposited 1,000 units into this bank account, this ABC bank account, what has to happen is, for ABC to balance his balance sheet, he has to have 10% of my deposits as reserves. Not that he's taking 10% of my deposits and putting it as reserves, but he has to hold 10% of what I have as reserves. Oh yes, sorry to say this, but he's taking 10% of my deposits as reserves so that he can use that 10% to loan it out or something else. Oh no, I'm confusing this. So he has to keep 10% of my deposits as reserves, and then he can lend out 90%. That's assuming we are in a fractional reserve lending system or banking system, which we're obviously not. But even though we're not, banks are still required to hold reserves for this particular reason, for safety. So going back to how QE goes into all of this, so those are the reserves, those are the normal bank reserves, and then there's excess reserves, which is the money that they make from otherwise things like the Fed buying treasuries. So this is what happens. The Fed goes like, okay, it's COVID, right? It's COVID. We want to launch QE so we can stabilize the markets and we can bail out the government. And we can drive interest rates lower, because that's what they do on the open market desk operation or open market operations. What happens is, in the open market operations, they just go to the primary dealers, or because they already have accounts with the primary dealers, they don't have to ask them. All they just do is, the primary dealers have a bunch of assets in their bank balance sheet. So they have assets like treasuries, right? So what happens is, the Fed buys treasuries. It just creates bank reserves out of thin air. It prints bank reserves, quote unquote prints, because it's not actually printing it, it's just typing it on a bunch of keyboards. Let's say they want to buy 100 billion worth of treasuries, so the Fed just goes on the keyboard and says 100 billion, and then boom, 100 billion has been created in bank reserves. This is not actual paper. This is why these deflationists are saying it is not inflationary, it's deflationary, and I'll explain that. So they just they just create this money out of thin air, this bank reserve out of thin air, and then they credit the bank's checking account with more bank reserves. And then in exchange, the bank reserve gives the Fed treasuries. So the Fed just takes treasuries off the bank's balance sheet, and the Fed credits the banks with new bank reserves, right? So how does QE work? Particularly, I just explained how it works, but how it really works is, the government goes in auction. Janet Yellen, the Secretary of the United States Treasury, goes out and creates this auction and wants to auction out government bonds or government debt in the form of treasuries. That's what it's called, or T-bills, or whatever you want to call it, but let's just call it treasuries, right? So Janet Yellen, sorry for that, it's Janet Yellen, because it's a kind of a tongue twist, but going back to the point. So what happens is, in these auctions, government creates these auctions, and what they say is, Janet Yellen says, she wants to spend 1 trillion on stimulus because it's lockdown and people need money and everything like that. It's a crisis, it's a financial crisis. We need to bail out the economy, we need to give people stimulus checks. So the stimulus program costs 1 trillion, right? But where does Janet Yellen get that 1 trillion? Because she can't get it from taxes, because there's no way taxes is enough to cover that 1 trillion, because the taxes are already going elsewhere. Maybe social security, maybe infrastructure, who knows, whatever nonsense it's going at, whatever Ponzi scheme it's going at. That's not the point. So the Treasury wants to raise money. So that's what they do in auctions. So usually prior to 2020, they auctions, the supply of treasuries that they would release in the public wasn't really that much. It was really constant, because you can look at the TGA. The TGA is the Treasury General Account. This is the checking account that the Treasury has with the Fed. So the government, in the form of the Treasury, has a checking account with the Fed, right? The central bank. So this is called the TGA, the government's checking account. Just like I have a checking account, which is a deposit of the commercial bank. Same thing with the Treasury. The Treasury, Janet Yellen, has a checking account with the Fed, and that's called the TGA, Treasury General Account. I hope we're on the same page. So what happens is, Janet Yellen wants to auction out a bunch of treasuries to fund a stimulus plan, a $1 trillion stimulus plan. So what happens is, Janet Yellen auctions out 1 trillion worth of treasuries, right? So she floods the auctions with a lot of treasuries, and she knows that the Fed is going to buy them. But here's the thing, the Fed doesn't buy directly from the Treasury, because if the Fed buys it directly from the Treasury, the Fed has to create new bank reserves and give those bank reserves to the Treasury, or just credit the TGA's account. So now the TGA has new money that came out of thin air, and then the TGA or the Treasury can just spend that money into existence. So that is the first thing, but that's not true. That's not what's happening. The Fed isn't buying directly, because according to the Federal Reserve Act of 1913, I don't know about the amendments, but according to that, it is unconstitutional for the Federal Reserve to buy bonds directly from the government. Directly. It didn't say, I'm not sure if it's illegal completely, but it's illegal for them to buy directly. So what they do is, they don't want to buy it directly, they want to buy it from the primary dealers, the banks, right? So what they do is, they create these open market desk operations, whatever the hell they call it, and then they buy it from these banks. As I explained a few minutes ago, they do it, they credit the bank's reserves, and then they take the bank's treasuries, and then it's a done deal. And I haven't even spoken about reverse repos, which I will speak about later on in this episode. So going back to the whole thing, the government, the Treasury, Janet Yellen, auctions out 1 trillion worth of treasuries, right? So she auctions out 1 trillion, and then all the primary dealers and money markets and the public, but the public is not really buying treasuries right now, as we can see, and foreign banks are buying it through the euro dollar system, but I don't want to get into that. But everyone is buying these things. Let's just focus on the banks that are buying it. So the primary dealer banks are buying all these treasuries at auction with money or with bank reserves. This is something important. The banks, the primary dealers, are buying these treasuries at auction with bank reserves. This is something the deflationists don't get, because the deflationists say if the Treasury is getting this money from banks, it can't be inflationary because it's not new money. Except that it is new money, because these are bank reserves. These are bank reserves. The Treasury never had that money before. The bank reserves were never, and I repeat, they were never ever in the economy to begin with, unless it was bank reserves from deposits, from customer deposits. So this is actually very interesting. So what happens is, the Fed basically says, okay, we will give you bank reserves so you can buy treasuries, and then after that you will give us these treasuries. So the banks are buying these treasuries at auction with the Fed's money, with the money that the Fed gave them, because the banks or the primary dealers are playing the shell game with the Fed. So the banks know that the Fed needs these treasuries so that it can keep interest rates low, and the banks also want money. They want bank reserves so that they can gamble in the stock market and borrow other banks or something like that, because you can't do a lot with bank reserves because it's not real money. So you just have to go ahead in the financial market casino. But regardless of that, what happens is, the Fed knows that the bank wants bank reserves and the Fed wants treasuries. So the Fed gives the bank reserves first. This is something we have to explain explicitly. We have to explain it very carefully. The banks get the bank reserves from the Fed first, which is an excess reserve. I spoke about excess reserves. I'm not talking about the normal bank reserves, which are from customer deposits. That's why deflationists are saying it's not inflationary, because if they're using 10% of customer deposits to buy treasuries, it's the same money that's just recirculating. Well, that's not true, because they're not using the actual bank reserves. They're using excess reserves. That is what they're using to buy treasuries. And where does the banks get money from excess reserves? They get it from the Fed. So the banks sell treasuries to the Fed, and the Fed just credits their excess reserves with more excess reserves, right? With more excess bank reserves. So this is all inflationary because that money came out of nowhere. Even though the Fed isn't directly buying it, what is happening is the Fed is basically playing a shell game with the primary dealers. As George Gammon likes to say, I forgot to credit him on that. The banks are playing a shell game with the Fed. This podcast episode is proudly sponsored by Libertex, arguably one of the biggest forex brokers of the 21st century. Libertex has a wide variety of financial instruments to trade with, from currency pairs, stocks, energies, and even a broader variety of commodities to trade. I personally use Libertex, and the one thing I love the most about this broker is their incredibly low spreads. Libertex has been operating since 1997 and has won over 30 prestigious awards worldwide, and is even a sponsor for Tottenham Hotspurs. So click the link in the description to sign up and enjoy the perks that come with trading with a world-class broker. So the banks, let's think about it this way. Let's think about it in this perspective, right? So let's say QE starts in 2008, right? QE, I think that's when it really took off, in 2008. That's when bank reserves really started exploding. So as we know, 2008 was never inflationary at all, and I'll explain why. This is what happens. So in 2008, let's say banks have no excess reserves, right? They have no excess reserves. I believe they didn't really have excess reserves until post 2008. So what happens is 2008, the financial crisis happens, and now the Fed has to bail out these banks. So what happens is the banks have all these treasuries, but the banks want to be liquid. The banks need liquidity. So that's why gold also fell, because banks had to sell gold, and then obviously gold rallied again. But that's not the point. The point is banks need cash, or not really cash, they need bank reserves, right? So they can bail themselves out. Even though bank reserves isn't real money, it's just the bank's money, if I can say it like that. It's not printed money. So the banks need bank reserves. So the Fed creates money out of thin air and buys treasuries. So what happens is, firstly, this is what happens. I want you guys to listen to me carefully. This is what happens at first. At first, the bank uses the bank reserves, which are 10% of customer deposits, right? And then goes into those auctions and buys it from the treasury, from the national treasury, from the government, if I can say the government, because I think saying the word treasury is a bit confusing. So they buy it from the government, right? So they buy bonds from the government using existing dollars, right? Existing bank reserves, which were customer deposits, right? So this is not inflationary. In fact, it's deflationary. And I'll just explain this now. So what happens is they use existing dollars that were already existing through customer deposits, 10% of customer deposits, and they are buying treasuries at auction, and the government is using that money to, I don't know what, spend money in the system. I don't know what they did with that money. But here's the thing. The treasury wasn't even issuing a lot of bonds at auction at this time in 2008. They weren't issuing a lot of auctions. They weren't issuing not a lot of auctions, but they weren't issuing a lot of bonds. If you can look at the TGA account, the TGA account really just spiked a little bit in 2008 and kept spiking up and down, up and down, up and down. But it was very small spikes if you look at the chart and compare to what's happening right now, the unprecedented amount that is happening right now. So going back to the point, what's happening is the TGA is not really raising a lot of money. They're just raising, maybe each auction they're raising like 100 billion. Maybe they're selling 100 billion worth of treasuries. Okay, that's fine, 100 billion because of the financial disaster and things like that. So the banks buy it with dollars that were already there in the first place. So that is not inflationary. In fact, it's deflationary because it's let me just explain it now after I explain how the Fed is in this picture. So what happens is the banks buy these treasuries at auction using existing dollars, and then once they have the treasuries on their balance sheet, what happens is the Fed monetizes that debt by buying it from these banks and just creates bank reserves out of thin air, because the Fed doesn't have money. They just create money. So they just buy those bank reserves or they buy the treasuries from the banks and just credit the bank reserves, right? So now they are crediting the excess reserves. I want you guys to get this. They are crediting the excess reserves, right? So remember that. Now for the first time, now banks' excess reserves are going up, and now the Fed is now using monetary policy to create interest rates on excess reserve, because the Fed is paying banks to hold their excess reserves with them. Maybe 10 basis points, 5 basis points, very, very small percentage, but it's still a lot in the bank's terms, because I mean it's $1 trillion. I mean 5 basis points of $1 trillion is still a lot of money, guys. Don't believe me, it is a lot of money. So that is a lot of money that banks can use. So the Fed charges IOER, interest on excess reserves. So the Fed, let's say for now in 2008, the banks finally have something as excess reserves in their accounting, has something called excess reserves right now, and the Fed is paying them interest on excess reserves. So now those interest on excess reserves, the money that's in the excess reserves is new bank reserves. We have to understand that it is new bank reserves. Those new bank reserves were never in the economy to begin with. So I'm not saying that 2008 was supposed to be inflationary, because it wasn't, because the government got the money from the banks not using excess reserves but using customer deposits, the reserves of customer deposits, which means it was existing dollars in the system, and now these excess reserves are now trapped in the financial system, right? So it's not inflationary, it's deflationary. Let me explain why it's deflationary. Because when banks hold treasuries, right, if let's say the Fed is not buying treasuries, if the banks have treasuries and they gave the government money and the government gave them treasuries because they auctioned those treasuries, it's newly minted treasuries. What happens is banks have these treasuries and then they get earnings, right? So banks, the government basically has to pay the banks back at some point, and then the treasuries disappear from the assets. So the banks, that's future liquidity from how much they're gonna make off these treasuries, right? This is future liquidity, because when you hold a government bond, a treasury, right, you have to, let's say I buy 1 trillion worth of treasuries, right? And then I know in the future the government is going to have to pay me back 1 trillion with interest according to whatever the market interest is, the yield on the bond or the treasury, the yield on the treasury, whatever treasury it is. So there is future liquidity, right, when you have treasuries. The treasury itself is not the liquidity, but it represents future liquidity, which means the banks are going to get their money back with interest by holding these treasuries. So when the Fed comes in and buys treasuries, it's basically forcing the banks to not have future liquidity, because whenever there's future liquidity, that is good for banks because banks can lend more money, but I'll explain that later on. So instead of now the Fed comes in, now what the Fed is doing is they are coming in and they are buying these bonds from the banks with new bank reserves. Now the banks have excess reserves, right? And so now that the banks don't hold these bonds, the banks have no future liquidity. They only have the liquidity that the Fed gave them now. So because the banks don't have future liquidity, they are saying that that is deflationary, because there is no longer future liquidity which banks can use to lend, because bank reserves is the money that banks can lend. So if banks have more bank reserves, they can lend more money, because whenever a bank issues a loan, it's issuing a loan against its bank reserves or its reserve assets. So right now, since there's no future liquidity, in the future it'll be deflationary. So when the Fed is buying these bonds, according to the deflationists, it means that the Fed is saying that in the future we will have deflation. That is exactly what they're saying. That is exactly what's happening with QE, except that with 2020, the circumstances are different. So I agree that in 2008, QE was in fact deflationary. I do agree with you. I do agree with you deflationists that it was deflationary because it took future liquidity out of the system through forced liquidation of treasuries. So the banks had to liquidate their treasuries and get the money now. So it's inflation now and deflation tomorrow. That's why I'm saying it's future deflation, because they remove future liquidity, because money is inflation. So now that they remove future liquidity, that is deflationary. But 2020, that's not the same story, because since 2008 the Fed has been doing QE with the banks. QE1, they did tapering, they tapered their asset purchases, and then they went back to QE, QE2, taper, QE3, taper, QE4, and then we recently saw QE4 in the repo spike in 2019, but I don't want to get into that. So now whenever the Fed is doing QE, that money, those bank reserves are excess reserves. This is very key, guys. They are excess reserves. I don't know how many times I must say this. These are excess reserves, and you will understand right now why I'm saying excess reserves are important. Because prior to 2008, as I said, the banks didn't have excess reserves, or maybe they had a little bit of excess reserves. I don't think they had any, because from the article that I just read, they didn't have any excess reserves. But now that they've been building up on this excess reserves, and right now they are continuing to buy treasuries from the government, but they are not buying it at accelerated rate, right? They're buying it at a very slow rate. So that is not inflationary, because they're not buying it with those excess reserves. Maybe they are, but I'm not sure if they were buying it with excess reserves. But 2020 March, when Janet Yellen said, oh, I need 1 trillion, or it wasn't Janet Yellen, guys, sorry, because Janet Yellen is the new Secretary of the Treasury. Before, it was Steven Mnuchin. So Steven Mnuchin is like, oh, I want 1 trillion because I want to spend in the economy. I want to give everyone stimulus, which was signed by Trump. Ironically, because Trump is supposed to be small by government, but nonetheless, let's continue with what I'm talking about. So Steven Mnuchin says, oh, I want to spend 1 trillion in the economy. Okay, Nice. Then the Fed says, oh, don't worry, we'll monetize it. But the Fed is not doing it directly because it's unconstitutional. Remember what I said in the beginning of this podcast? It is unconstitutional for the Fed to directly buy it from the Treasury or from the government. So what happens is now the TGA has shot up. The TGA, the Treasury General Account, the checking account of the government with the Fed, that account shot up because the government got so much money from the banks through these treasury auctions. So what happened is the banks did not buy those treasuries with the traditional bank reserves. They did not. They didn't, guys. This is something we have to understand. They did not. They bought it with excess reserves that they had, that they've been getting from the Fed. And these excess reserves are new bank reserves. So this is money that has never been in the system. Even though the Fed isn't buying them directly, technically they are buying them because now banks have excess reserves, which was never ever in the system to begin with. So now the banks bought these $1 trillion worth of treasuries with new money or with new bank reserves. So what happens is they've bought it with new bank reserves, and the government takes those new bank reserves, and then basically what it does is it gives people checks, it gives people stimulus checks, and then those people deposit their stimulus checks in their bank account or vice versa. I don't know how it works with the stimulus, but now the stimulus is new money, not because the Fed bought it directly. I think that's why the deflationists have it wrong. But at the same time, when the deflationists explain this process, the deflationists make people who can't think actually believe they BS. I'm sorry to say that these deflationists are very smart people, because this is where I learned it from. I learned it from the deflationists. I just had to think, okay, even though QE is not inflationary, aren't the banks using new bank reserves to buy treasuries at auction? So if they're using new bank reserves, that has to be inflationary. I spoke with my good friend Kakekotao on this late night call. I think it was at 2 a.m. It just troubled me, so I needed his insight on it, and he gave me good insight on it. But really, this thing is inflationary because banks are using new bank reserves, or they're using bank reserves that were never ever in the system to begin with. They were only in the system because of QE. So all this talk about bank reserves being trapped in the interbank system, bank reserves being trapped in the financial system, that is BS. Yes, to a certain extent that is true, until the government is using those new bank reserves and giving out stimulus. Because if the banks are buying treasuries with those bank reserves that they got from the Fed in the past, in 2008, from 2008 to 2020, if they're using those bank reserves, then that has to be inflationary. That is inflationary because now it's new money, and that is why the money supply expanded. That is why the money supply increased. It didn't increase for no reason. If it didn't increase, then the deflationist argument would be correct, that they're not using real money. But you can say that, since banks are now offloading treasuries, isn't that deflationary because it's removing future liquidation? Because now there's no longer future liquidity. They've pulled future liquidity out of the system. So now the banks are not going to get more liquidity in the future because they don't hold treasuries anymore. No, that is not true. Because, okay, it is true to a certain extent, because it is only true if the banks won't stop doing QE with the Fed. Because if the banks continue to do QE with the Fed, QE forever, that is not deflationary. That is not deflationary, because even if QE by itself is deflationary by taking out future liquidity or future inflation, or future liquidity, so that banks don't have future liquidity, they can keep the party going on by continuing to do QE. So they can just do QE until they reverse course and they stop doing QE. If they do QT, that's when it becomes deflationary. So that's how you know that this deflation argument is BS. So right now, it is QE infinity. We know QE is not going to stop because the Fed can't even taper. So because they have to continue to do QE, and as long as the government keeps spending more money, which they are going to do, this is not even a prediction, it's a fact. We all know what Biden's agenda is. And plus, we're moving into a new political system where we have a lot of young people who favor socialism, unfortunately. So a lot of young people, a lot of millennials and Gen Z people favor socialism. So because many people favor socialism and it's so important, people want their student loans to be erased. They want all these things that are highly inflationary. So therefore, Biden is definitely going to do that. If Biden doesn't do that, maybe AOC will be president next election. Who knows? But someone is going to do it with this new mindset, that with this new generation. So I am part of that generation, but I'm not part of that mindset, hopefully. I hope you guys are not part of that mindset as well. But basically, QE is deflationary. The main takeaway from this is the deflationists are right when they say QE is deflationary. QE, when you look at QE, how it's built, it is deflationary until the government is using new bank reserves to give stimulus. That is the only time it's inflationary. That is the only time QE is inflationary. So it's deflationary if banks were just using customer deposits to buy treasuries, right? If banks were using customer deposits to buy treasuries, that would be deflationary because it's sucking out liquidity. It's forcing the banks to liquidate their treasuries. Therefore, they don't have any future liquidity when the treasuries have to end at some point, where it has to mature at some point, because treasuries mature according to the years. Some are 30-year treasuries, some are 10-year treasuries, 3-month treasuries, 10-month treasuries, 1-year treasuries, 2-year. So it depends on which treasuries they're buying. So if banks have only been buying 10-year treasuries, it means in 10 years there will be deflation, because that money they were supposed to get money 10 years later, but the Fed just gave them money today. So it's inflation today, but deflation tomorrow, if you understand what I'm saying, guys. And the thing is, they also say it's deflationary because banks aren't lending. So because of this new bank reserve increases, because now there's more bank reserves in the system, the banks should be lending more because they have more lending capacity. Well, what's happening is the banks, even though they do have lending capacity, they're still not lending. Lending has actually went down. The only reason it went up in the beginning of 2020 was because of PPP loans by the Fed. So banks have not been lending. In fact, banks are lending less money in the real economy with loans, housing loans, like mortgage loans, student loans. They're lending less until the government interferes again. But banks are lending less. I agree, that is deflationary. But what we saw in 2020, the money supply increased by 25%. So if the government continues deficit spending, that is definitely inflationary. You cannot say that that is not inflationary. You must be stupid to believe that that isn't inflationary, because as I said, they're using new bank reserves to buy the treasury from the government at auction. The banks are using new bank reserves which they got from the Fed. So you have to understand, they got it from the Fed in the first place. So that is inflationary. Even though it might sound that it's not inflationary, it actually is right now in 2020. Prior to 2020, I don't think it was inflationary because the government wasn't doing as much deficit spending as it is today, because you can see that in the TGA. The TGA wasn't moving. It really remained stagnant. It was going up and down, up and down, up and down, but in range. It was in range. So therefore, if you can see that the TGA is not shooting, it's not going up ballistically, that is definitely not inflationary. Because if the Fed is the problem, is the inflation problem, is creating the inflation problem, surely the TGA should be exploding, right? So right now, which gets me to my last point, before I wrap up this episode, why I think the deflationists are going to lose this one, and why I believe inflation is not transitory. This confirmed my inflation is not transitory argument. Biden just announced the $400 childcare tax credit. So this is basically a childcare tax credit for parents, right? So 35 million families are going to get this. But listen to this, 90% of children are getting this credit. So think about it like that. If there's how many children are there in America? Let's just say there's 100 million children, right? Or let's say 150, half of the population is children. So half of the population is going to get $400 a month for the next few years. And there's still 5 payments to follow for the year. It's not saying it's going to end after these 5 next payments and it's going to end at the end of the year. They said it's going to extend for more than 1 year. It's going to extend for a few more years, maybe 4-5 years. I don't remember what the article said on CNBC because I read this on CNBC. So this is heavily inflationary. I do not know where the deflation guys are, because this is definitely inflationary. Despite the bond market saying otherwise, this is deflationary. This is inflationary. We can all agree that this is inflationary, because now the TGA's account has been going down, because now the TGA is having less money in the account. But now what's going to happen is they're going to have to, in order to pay for this, they're not going to pay for this with taxes. We all know that they're not paying for it with taxes, so they're going to have to pay for it with the inflation tax, which means the Fed is going to have to monetize the debt. As I said, they're not directly monetizing it, but it's still inflationary because the banks are going to monetize it with excess reserves, which were never in the system to begin with. That's why there is not I think there is, in this case, it's not a cash glut, but it's rather inflationary. So what's going to happen is the TGA is going to have to go, the Treasury is going to have to go, or the government rather, is going to have to go on auction and just go on auction and fool all these investors, all these banks, and the banks are going to have to buy these treasuries because they know the Fed is going to buy it from them anyways. So they're going to buy it. So, and then the Fed is going to create new bank reserves, and it's just going to create more inflation. So I expect the TGA's account to shoot up because they don't have the money to pay for this unless they borrow it from these primary dealers. But they're really borrowing it from the Fed. It's not like they're borrowing it from the primary dealers. Okay, directly they are, but in reality they're not. They're buying it from the Fed. That's something that the deflationists don't understand. Even though they're buying it from the banks, they're not really buying it from the banks, because the Fed is saying buy them so we can give you excess reserves. And then what's going to happen is the next time they want money, the Treasury or the government wants money, the banks are going to buy those treasuries with excess reserves, which the Fed gave them in the past. So that is inflationary. This is heavily inflationary. This is inflation. I don't think anyone is dumb enough to say that this is not inflation. You can forget about the BS that society is telling you, all these mainstream media people, all these deflationists are telling you. Sure, it was BS before 2020. It wasn't BS before 2020, sorry. It was deflationary before 2020. But now that the government is deficit spending like a drunken sailor, this is definitely inflationary. You can't say it's not inflationary because the Fed is going to monetize that, and that in and of itself is inflationary because they're not getting the money from existing dollars. And for those deflationists who say the money is trapped in the system, it is not. It is not trapped. If the banks are buying treasuries with those bank reserves, that means the system, it's not trapped in the system, because if the government is going to spend that money, that is inflationary. They are putting new money into the system, so the money supply is going to increase, everything's going to go ballistic. And don't say I didn't warn you. This is what's going to happen. Biden's childcare tax credit is going to last for many years, and imagine the parents with 5 children. Think about that. Parents with 5 children, or think about those welfare gals who have like 8 children. You know, those people who have so many children because for each child the government is gonna support you. The government supports you more when you're a single mother with a child. So you'd rather have more children so you can get more government support. And then that money is not really gonna go to the children. Maybe some of it is gonna go to the children. But you know, since the government is so generous, you're gonna use most of that money for yourself. We see the same thing in South Africa. I mean, ever since the government has been giving grants to ladies with children, for every child you have, you get this amount of money, which is the same thing with this childcare tax credit, which is $400 for each child. That is heavily inflationary. This is UBI, basically. This is UBI. So the moral hazard, as I was saying, in South Africa was these people in the villages and all these rural areas and townships and everywhere, these ladies started having more children. Obviously they have more children so that they get more money from the government so that they can spend it on themselves. Pure evil, I know, pure evil, but I mean, people want money. So what I see is, if this Biden childcare tax credit is actually gonna last forever, quote unquote forever, I don't think nothing lasts forever, but if it's gonna last for this long, for a couple of years, obviously they're gonna extend it because the economy is gonna get so used to it until inflation becomes a problem, and then that's really gonna blow the whole thing up in their faces. But these ladies are gonna have more babies, and then they're gonna get more money. So the government estimates that, oh, it's gonna cost this much money. They're lying. The government does not know how much it costs, because usually the government would say we are gonna have 1 trillion stimulus. Stimulus really costs more than 1 trillion, because there's a lot of fraud and there's a lot of moral hazard when government actually gives people quote unquote free money, because there's nothing free. As I said, this is highly inflationary. So consumer prices are going to go through the roof. Already they're going through the roof because of the stimulus people have been getting. Now this is going to be further exacerbated by these new government childcare tax credit. And really, it's not even a childcare tax credit. It's not a tax credit, because if you're giving someone a check directly into their account, because this thing is not new. This tax credit thing has been going on for many years, but it's a tax credit, which means you have a less tax burden, which means, let's say you have to pay $1,000 in income taxes, right, for the month, and then minus 300, whatever the credit is. So now you have to pay 700 because you get a credit. So you're paying less taxes, right? But this is different because now the money is going to every parent, regardless of whether you actually make money and pay taxes or not. So how is this a tax credit if people who are unemployed are also going to get it? How the hell is that a tax credit? Because a tax credit assumes that you have a salary and you are paying taxes. So if you don't have a salary, there's no way you're paying taxes, obviously, unless you have a business. But most of these people don't have businesses. So there's no way this is a tax credit. It's disingenuous for Biden and all these people like Bernie Sanders to call this a child care tax credit. They cannot call it a tax credit because it's not. If it's going into someone's bank account directly from the government, from the Treasury, National Treasury, that is not a tax credit. That is stimulus, or should I say that is UBI, because it's universal basic income. It's guaranteeing parents that they're going to get income every single month from the government through childcare tax credits. So even parents who already have jobs are going to get this money. This is inflation. I don't know how you see it. This is heavily inflationary. Of course, it's not all parents. It's parents who are earning less than $70,000. But most people in America earn less than that. So it's basically most parents in America. So we can just say, for the sake of this argument, we can just say all parents. All parents are going to get this thing, even though not really all parents are going to get this. But many parents are going to get this. Almost all parents and almost all children are going to get this. So this is highly inflationary. There's nothing deflationists can say about this. This confirms my argument that inflation is not transitory. I mean, inflation would have been transitory if the government stopped doing stimulus. Because that's what we saw. We thought that government is going to stop doing stimulus right now. I mean, they haven't done it since March until recently with this childcare tax credit. But I mean, if we knew that they weren't going to do this tax credit, then for sure inflation was definitely going to be transitory, and then the deflationary forces were going to kick in, and then we'd see this deflationary bust. As you can see, the reverse repos are going ballistic. Look at the reverse repos. The reverse repos are at 1 trillion a day. The Fed is doing reverse repos with counterparties, banks that are primary dealers, also money markets. So this is all deflationary. This is deflationary because the Fed is basically giving them treasuries, because when the Fed is buying treasuries, that is inflationary, but when the Fed is giving them treasuries, that is deflationary, because you can see now that the banks are the banks are leaving more bank reserves with the Fed and are parking it with the Fed. I don't think it's about the money. It's not really about the bank reserves, but it's more that banks want treasuries. They want collateral, which is the treasuries. So there's a demand for treasuries rather than there's too much cash, because that's the argument we all hear, but that's not true. It's not about cash really. It's about treasuries, the demand for treasuries. And with the money market funds, it's not really about cash, that they have too much cash. It's that they don't have they have nowhere else to put their cash, like to invest their money in, so they invest it, so they leave it with the Fed in reverse repos, and then they get a profit, they get an interest, which is 5 basis points on reverse repos, and then it happens like that. So banks, you can see this is counterparty risk. There might be also counterparty risk. I think George Gammon spoke about this. He spoke about it might not only be about a demand of collateral, which the government can just solve by issuing more stimulus. That's why I think this reverse repo problem is going to go away, because with this childcare tax credit, this means that the government is going to issue more bonds, and that is going to solve the problem of reverse repos. But if that's not the case, if that doesn't solve the problem, what's going to happen is maybe there's a counterparty risk, and that's deflationary, because there's so much debt in the system. So these money market funds don't want to invest their money in the stock market anymore because they think it's overvalued and they think it's going to crash, right? And you can see treasury yields on the 10-year going down ever since reverse repo started. But I'll explain all of this in the next episode, or in another episode rather, not the next episode. I'm not sure what I'll talk about in the next episode, or what Sia will talk about in his episode, or whatever episode we might be doing, but I will definitely follow up on reverse repos. But the main takeaway is that QE is deflationary by definition. QE has to be deflationary in the future. It's inflation today, deflation tomorrow. That's what Dr. Lacey Hunt said. Inflation today, deflation tomorrow. Except that the banks are using new bank reserves. They're using newly fresh bank reserves that they got from the Federal Reserve. That way it is definitely inflationary. QE prior to 2020, it was not inflationary because they were using customer deposits, and also they didn't have a lot of excess reserves, right? Banks didn't have a lot of excess reserves. I mean, they did have quite considerable amount of excess reserves if you look at bank reserves, if you look at the chart of bank reserves. So I think even if they did have a lot of bank reserves, the Treasury wasn't issuing a lot of treasuries at auction before 2020, so that can never be deflationary. So thank you guys for listening, and I will see you on the next episode.